Hello, hello. This is Thank God It's Friday, and once again we are joined by a very, very exciting market voice. This time we have Vikas Khemani. He's the CEO and President of Edelweiss Securities. Vikas, thank you for joining us.
Pleasure. Thanks for having me.
Because it's one question which is on everyone's mind. It's getting very hard to find new investment ideas considering the fact that the markets are where they are. According to you, what are those areas which still have little way to go in which you can put in your money and still see substantial returns?
So I think the way I think is that you don't invest into equities for shorter term. You invest into equities for long-term wealth accumulation, right? And if you have to, no doubt that markets are in a slightly zone which is slightly expensive, fair value zone. But if you see the overall India structural story, the growth which is lying ahead of us, I think there's a long leg to go, right? And there are a lot of ideas, lots of sectors which will still play out over the next 5-7 years. So I think if you are, in the game for long-term, for long-term wealth creation, I don't think it's a point of worry. If you are allocating your capital, which is you can take if markets go down a little bit, you can take that pain. Should not be worrying, because I am reasonably confident even from these levels.
Even from these levels?
Over the next 3 to 5 years, 7 years, you will create a significant amount of wealth as equities have created over the years in the past. It is no different in the sense you will see, and right now we, in some sense I believe that India's age of compounding has started, and we are around $2 trillion economy which can become $5 trillion over the next 6-7 years.
Absolutely.
So if that kind of situation, that kind of growth were to come, there's no doubt that India will see that kind of wealth creation in equities.
Right.
So if you are seeing that kind of horizon, it doesn't matter whether markets go down tomorrow by 5% or not, unless you are a leverage player.
Right.
Alright, but the biggest fear that's playing on the market participants right now, or the next big trigger or big event that people are talking about, is of course the GST implementation. I want to understand, in your opinion, how real are these fears? Because if we talk about demonetization and the kind of correction that we saw in the markets after that, it was probably because it was more of a surprise event, but when it comes to GST, it has been like widely expected, known and discussed. So do you really think, or how do you think the markets will react to this disruption which is widely expected to be caused, and probably some short-term earnings hit that may happen because of this? Would you be a buyer then? Would it be a good opportunity to buy if that happens?
So part of the answer lies in your question itself, that when everybody expects that there could be possible disruption because of GST implementation, while believing that it's a long-term opportunity, long-term good for the country and for the sectors, probably it won't correct, right? Because every time some disruption happens, let's say hypothetically some companies' numbers go down by 20%, market will say that, oh fine, it's one-time effect and it will come back. So you won't see that kind of. So typically reactions happen only when there are surprise events, like you mentioned, demonetization. This is by and large expected. And secondly, my core belief is that because of GST implementation, the end product demand is not going down.
True.
At best you can see inventories getting emptied or filled in the channel. So to that extent, the numbers can get preponed to Q1 or postponed to Q2. Nothing beyond that, because I don't think consumers are stopping to consume. Goods are stopping to get sold at the retail outlet level. So I think it is the inventory correction of the channel, which I don't think will create significant amount of disruption. So I think, in my opinion, some of these worries are a little bit more overplayed, and I think market will definitely overlook that because it's only 1 or 2 quarters of disruption at best.
Okay.
Because in terms of overlooking a lot of issues, markets have clearly overlooked a lot of global, risks that have been laid out over the last entire 1 year. However, what we've also noticed that in the last few months, we've seen a little bit of tapering in FII flows and equities, while debt remains robust. Is this a worry, and if at all, there are any global risks that you are keeping an eye on going ahead?
So no doubt, I think we have a situation where, because of the domestic strong flows, markets are where they are, and I think they are real. So they are not sort of short-term and artificial flows. I think they are real. The international fund side, we have had a good amount of exposure to India, and I think we have seen most emerging market funds overweight on India. And I think post demonetization, post US Trump victory, you saw some sort of correction across an emerging market, which has kind of recovered. Flows also have recovered. So I do believe that we will continue to get slow and steady flows from FIIs as well. I am not really overly worried. I think the investors we meet, talk, most people are bullish on India structural story. I think from asset allocation perspective, flows perspective, overall flows towards emerging market will drive. Incrementally, we are seeing even India dedicated funds coming to become reality, and more of them are coming. So I think we will see India flows will remain strong. I don't have any doubt. There might be a little bit of short-term slowdown, but that's fine.
Because I want to address the banking system here, given that the Reserve Bank of India's intent to resolve this bad loan issue in the system is finally translating into action, and they've been fast tracking a lot of these issues. Do you really think it is a good time to start looking at PSU banks, or do you think it's still safer to stay and put hold with the private sector banks? I mean, does RBI's intention and action sort of tilt the favor even slightly towards PSU banks, or even if they are tactical plays?
So I think exactly. So I think there are two parts to it. One, to play banking and financial services story structurally. Second is to play trade on the banks which are struggling from asset quality issues. Undoubtedly, I think as far as the NPAs are concerned, we are coming after recognition and provision. The third stage of resolution is coming about. So by and large, I think provision is we are halfway or a little more than halfway there, and resolution has started becoming almost a reality. So I think you will see that fast forward process happening, and in that process, I think PSU banks will end up doing well. But at the same time, I think structurally the trend is against them from market share perspective. And if you are looking to play over 7-8 years, the structural credit growth, the growth in the financial services industry, I would say private sector banks are better placed over a long period of time. So it's up to investors what they want to look at. But I think by and large, I think banking sector is very well placed. And also, mind you, banking is one of the biggest opportunity as any economic grows, and in India I think we have multiple levers of or multiple catalysts of this growth. I mean, financial inclusion being one. In my opinion, financial inclusion is one of the biggest transforming reform this government will push forward, and I think with that you will see long legs of growth on this. Our savings rates are going up. The overall savings getting intermediated towards the users of the capital will happen. The banking profit pool, which currently is, let us say, approximately about $20 billion, over the next 5-7 years can go to $100 billion. Now this 5x growth in the profit pool of BFSI will create huge amount of opportunity, huge amount of wealth. So I think I would rather play this long trend of sustainable structural growth than a tactical play. But I think it again depends on the investor risk appetite, investor interest, how they want to allocate the capital. But my favor is always for being part of a long structural growth story, so you don't have to worry about it, just can keep on compounding and you don't have to do anything.
So clearly you like private banks then, as and that's the view the entire street does hold, at least for the long term. Another sector that we really saw taking a knock today and has been over the past, in the recent past, is pharma. Today there was a Bloomberg report which said that Trump officials were readying a drug pricing executive order. There's a section of market experts which believes that it's a good time to start picking certain quality pharma names given the kind of valuations that these stocks have come down to. My question to you is, do you really believe that the worst is actually over for pharma?
So well, I am not a pharma expert, but I think only based on how I understand and interact with our analysts, I can only say that I think there are multiple things against you. One is this whole regulatory backlash which has been going on, and currently also we don't seem to get any end to it, right? Even every alternate week we kind of end up hearing something. Secondly, I think you have pressure on the pricing side, because which is almost given, right, in the international market. And I think domestically also there are a lot of noise about having generic drug, making medicines cheaper for, and government is also kind of working. So I think I still believe that there are still many headwinds for the industry, and you should not be investing in any sector just because it has become cheap, because it can become cheaper, provided I think something is changing, and I currently do not see any of these headwinds changing. So if there is no change happening, why to go and just because it has become cheaper? There are multiple other opportunities where there are a lot of tailwinds in their favor. So rather I would stay invested in the sectors where there are tailwinds rather than investing into a sector where there are headwinds but stock prices are corrected.
Right. You know, Vikas, there are a lot of other emerging themes. For example, you spoke about savings, which means that a lot of physical assets will be transferred into financial savings, which means that you will have insurance companies, depositories doing well. Are there any other such themes that you are keeping an eye on with a view for the next 10 years, for example?
So I think financial services is a very, very big theme across us. I mean, so far we have seen financial services in form of banks, to some extent NBFCs, and it is slowly expanding. So insurance companies have been coming out.
Yes.
We are seeing depositories coming out. Mutual fund is something you will see again hitting the market, soon probably. So I think this segment is widening. You might have some fintech companies coming in. This whole segment is a very, very big opportunity.
Right.
Currently, we are about 10% of the financial household saving and overall 20%. So, $200 billion comes to financial markets every year, and which is growing.
Right.
So, if I were to let's say take a number of $5 trillion 7-8 years down the line, this number will go to 500 to 800 billion dollars of saving getting getting intermediated through the various channels, which is banking, capital markets, and insurance. Now, this is going to increase the profit pool. This is going to increase the diversity of the sector. Right. Earlier, we did not have small finance banks. Earlier, we did not have a lot of opportunities which are there today. So, I think one should keep, and this segment will keep on evolving. So, one should keep an eye on this this particular big block of opportunity, and we remain very, very positive. Right. I think it is once in a lifetime kind of opportunity, and organization will get transformed in this way.
Right.
Okay, all right. Do you also share the street's optimism when it comes to housing finance companies, though?
I do, for the simple reason, again, because that India still is significantly under-penetrated on the housing side. Current loan outstanding is about 14 lakh, 15 lakh crore of the outstanding loan for housing finance across put together, banks and housing finance companies and all. And if again we were doing some estimate, by 2025 this number will go anywhere between 65 lakh crore to 70 lakh crore.
Right.
Now, if this is the kind of growth, and obviously there are a lot of catalysts. One is the rise in the per capita income. Secondly, I think the initiatives by the government like affordable housing for all or housing for all by 2020, those kind of initiatives are, and also implementation of RERA, they will all fast forward this process. So this is a humongous opportunity. Over the next 5 years, if you have 5x growth in the outstanding loan, you can imagine what kind of opportunities it can create, and we will see that planning out. Now, obviously, everybody may not be successful, and also I believe that this is relatively, especially in a market like India, where the loan to book ratio is still very conservative.
Yes.
There are long legs to it, and obviously, some point in time there will be exuberance around this, and partly it is also getting built because I think there are very few companies participating in it. So we will see, but idea is to identify right stocks and playing out. Opportunity is large, but you have to be sensible in terms of where to play.
True. I just wanted to ask you, which are the areas or themes that you would definitely avoid, because everybody talks about what they like. I want to understand what you would definitely advise not investing in at the current valuations. You already spoke about not being very bullish as far as pharma stocks are concerned. Is there any other thing that where valuations really worry you?
No, valuations worry me all the time.
All across.
It's not that you cannot invest without worrying about valuation, and you should be worried of the risk. You should be worried. So I'm not making a point that
structurally is there some industry?
You should invest into. You should avoid sectors where there are no differentiator, a lot of commodity players, and also there is some sort of that there is some sort of sunrise. So let's say, hypothetically speaking, we know that coal as a fuel will probably all be not relevant, or slowly dying, or maybe fossil fuel is also probably not going to be there for long, right?
Right.
Now, if that is we know that 10 years down the line that it is fast changing with the renewables coming into play, lots of technological disruption happening. Now, if that is the case, that even if something is looking attractive, why to play that? When we have so many other choices in terms of investing, because in India right now multiple sectors are firing, multiple segments are firing. So I would avoid where either the structural headwinds are there against the industry, either in form of technological disruption or competitive structure of the industry, or the nature of the industry. Or I would always avoid where management quality is not very good, sectors are not really companies which are where the history of the management is not really good. I mean, those kind of things are more specific. But other than that, I think in market, I believe that there is nothing untouchable. You know, you have to evaluate everything. You know, keeping in mind the opportunity valuation and possibility of sort of return from there. So it's a combination of fundamental, technical, and pricing. You can't really see anything in isolation.
Okay, so from our conversation, we've definitely picked up the fact that Vikas really likes banking and financial services. Of course, he's bullish on that. If I were to ask you, what are your top 3 favorite themes or sectors? I understand you have to be stock specific, but broadly 3 industries that you really like. You've said BFSI was one. What would be other 2?
So I think there is very big, and this again next 4, 5, 7 years perspective, I'm saying, there's a very big shift which is happening in Indian economy, which is unorganized to organized, and there are many catalysts to it, many legs to it. One being obviously some of the regulatory changes like GST, implementation of GST, demonetization. They have fast forwarded the process of unorganized industry getting into organized one, right? Other than that, there are things like premiumization of the products, where as per capita income goes up, people tend to demand better quality product, premium products, and which can generally be provided by only the organized player than as compared to unorganized player.
Right.
Things like economies of scale can only come through technological advancement, only can come through organized player than really unorganized players. So I think there are 6, 7 legs or levers to catalyzing this shift from unorganized to organized, and I think the great part about that, this cuts across many industries. But this shifts there are industries where 80% sector is unorganized, there are industries where there is 40-50% unorganized. But all of this over next 5, 7, 8 years, you will see moving towards organized segment. And you will see lots of beneficiary companies in that. It could be building materials, it could be tiles, it could be textiles. You can go on and on in some sense that there are lots of industries in that. And I think that theme, in my opinion, will play out in a big way over many years. Other one I can say, I think another interesting thing in India is happening. Huge amount of investment is happening in infrastructure, and obviously led by government. So whether it is urban infrastructure, metro, railways, ports, roads, across the board. And we are seeing some, numbers are staggering, like railways 8 lakh crores.
Yeah.
I mean, numbers are staggering.
Right.
There are 30 metro projects going on in the country. Now, if that kind of plants are there, you have somebody to do it, right? I mean, so you will have EPC companies to do it.
Right.
Now, how many EPC companies are there in the country? After Larsen and Toubro, the second largest company is only 10,000 crore in revenue.
Right.
So I feel there is structural changes happened in this segment, where the 3 C's of this industry is changing. Earlier, this industry was suffering from corruption, competition, and capital cycle.
Okay.
And all 3 which were against it, has become in favor of this industry. Corruption has gone away, competitive intensity has gone down,
Right.
A, because of the more work, and B, because of the broken balance sheet of many players.
Right.
And C, I think, since there is a huge amount of pressure on the government to get things done, this cycle of the project cycles have come down, and that reduces overheads and that reduces the capital requirement. So all 3 are, in my opinion, structurally changing the whole sector. This sector will create huge amount of value, number of companies, new ideas. I think, and this is also, in my opinion, slightly ignored sector by many long-term institutional players. So you will see, I think, in my opinion, huge amount of value creation in this as well.
Because I like the way you said that the 3 C's for infrastructure sector have gone away, but what the issue really here is, or the question here is that when do we actually see all these favorable arguments for infrastructure actually translating into financials, because that hasn't happened for the longest time. Plus, given the current low capacity utilization levels in this industry, I mean, when do we actually see that pickup, and that pickup translating into financials? So, I mean, is this really a good time to start looking at infrastructure stocks, or that for it to reflect in the financials is still some time away?
No, it is already happening. So the first stage of this is order book accretion. Second stage is revenue.
Which we have started seeing this quarter, yes.
Order books have been building since big time. So, and we are seeing more and more projects coming up for bidding. companies are taking, revenues have grown. I think if you see, most of these companies have grown at least 15 to 20% in top line and bottom line, and I think these companies are also scaling up their capacities. So there's no case of underutilization of capacity out here. I think most people, we are coming out of reasonably bad period in this industry. So there are three kinds of companies: either broken companies or companies with the scars of the past, and the fresh company. So new companies are fresh companies are making best out of it. Companies with the scar of the past are kind of slightly moving with their cautious approach, and broken companies can't capture it. So I think this is the second and third category which are kind of making best out of it. If you analyze those companies, you will find they're doing well on that, and they will be the ones which will kind of
actually outperform
and do well.
Okay.
Well, a final question from my end, at least. We have a lot of young investors watching us. 2 or 3 points that you would say that this is definitely done for me, and I'm going to pick this stock, and 2 or 3 points that would make you decide, no ways, I'm not touching that stock at all. What would those be on a generic basis?
So I mean, I obviously look at whether how is the industry structure growth. So, I mean, I start with a big theme in the sense this is going to be a big theme and this is going to play out. And within that, then you have to identify companies with sound management capability, management which are aligned for long-term growth, with long-term mindset. Because any company with the long-term mindset, good quality practices, only create value from long-term perspective. So I would say overall macro theme, within that go and identify good quality companies. And obviously, you have to look at financial, you have to look at valuation. But I don't mind paying higher price for a good quality company.
For a quality company,
if as long as it delivers. And it has capability to deliver from a long-term perspective. So I think that is one. And secondly, I think even in the sectors where things are broken, the thing you have to identify if from headwinds, if there were headwinds and things are changing now, and environment is becoming nice. So turnaround stories are again stories where huge amount of money is made and wealth is created. So another sector I typically look at is where turnaround stories, where there are high operating leverage possible because of some macro or headwind environment. They have gone into rough weather, and as the environment is changing, they balance, because they are good quality companies and who survived the tough times. But when the times change, they create significant wealth for because they were ignored, so prices were really low. So they trade at 0.2, 0.3, 0.4 time book, and when they change, suddenly the operating leverage kicks in, and that 0.2, 0.3 times book ends up becoming 2-3 times, and that is where you make 8 to 10x. So my favorite play again, other than structure stories, also look for turnaround stories, and it's hard, it's not easy, but if you do work, I think you can find many of them.
All right, betting big on banking and financial services while avoiding pharma is Vikas Khemani's view. But that does bring us to the end of this edition. Thank you for watching. Have a good weekend, and we will see you back on next Friday.